Hello, hi there. My name is Krishna, and if you guys are looking forward to studying manufacturing account under the A-level syllabus, you are in the right place. So let us begin without wasting much time. Let me use my highlighters, little pointer. So to understand your manufacturing account, first we need to understand the nature of business. So if you look in the figure out here, here's your manufacturing business in the right side. There's a factory out here, and the towards your left side, there's the non-manufacturing business. Non-manufacturing business, you have the wholesale business out here and the retail business. So how does the system work? Let's understand first thing, the factory produces the goods. They are bought by the wholesalers. The wholesalers sell it to the retailers, and the customers buy from the retailers. This is the basic chain. But here the customer, he has the option to buy from any of these three. He can buy from the wholesale, he can buy from the retail, and then he can also buy from the factory. But in normal situation, the customer buys from the retailer because retail business are available everywhere, while wholesale and the factory are limited. So let's understand about accounts. In our AS level, we studied how to prepare the financial statements of the non-manufacturing business. Let's recap what were the financial statements we prepared for non-manufacturing accounts. So, what is manufacturing and non-manufacturing account? Manufacturing business, they manufacture products. Non-manufacturing business, they don't manufacture any products. That's the basic difference. So, in our AS level, we studied how to make the income statement, which is comprised of trading account and the profit and loss account, and then there was the statement of financial position. So these are related to your non-manufacturing business, or you can simply say trading business. This business do not produce any goods; they buy and sell it. Now, for the manufacturing business, it produces goods, and then it also sells it. So manufacturing business has to prepare the same financial statements prepared by the non-manufacturing business. So it means manufacturing business has to prepare all this, both the income statement and the statement of financial position, as well as one more extra account, and that's called the manufacturing account. So that's what you need to understand. Simple. Manufacturing business prepares manufacturing account along with the income statement and statement of financial position, because it wants to know how much profit it has made by manufacturing the goods. So let's move forward. The format of the manufacturing account. So I'm going to show you the format of the manufacturing account before we go into deep learning about what they mean. So this is a sample of Nilisa Company Limited's manufacturing account for the year ended 31 December 2020. So if Nilisa is making her manufacturing account, this is the basic format. The first thing she has to do is get the value of material consumed, and the value of material consumed is obtained by using the formula open inventory of raw materials, add purchase of raw materials, add carriage inward, less closing inventory of raw materials. So if you solve this, you get 20. These are random data. 20. Then you add the direct expenses. This expenses out here refers to direct expenses. I was supposed to put direct. Let me put direct. So the direct expenses, you add up the direct expenses and then direct labor. So you have material consumed at 20, and then there's direct expenses 10. Example, royalties are direct expenses. Then direct labor 10. You add this up, you get 40. This 40 is called the prime cost. So in prime cost, we add factory overheads. Some of the examples of factory overheads are indirect material, indirect expenses, indirect labor 10. heating and lighting, power, depreciation 10, other factory related expenses 10. You add this up, you get 30. So when you add 40 plus 30, you get 70. That's your manufacturing cost. In the manufacturing cost, you add opening work in progress less closing work in progress 10. And when you solve this, you get your total production cost. Now this total production cost is transferred to the trading account. So Nilisa Company Limited trading account. In our trading account, we have the revenue. We know how to prepare the trading account, which we studied in the AS level. Revenue less cost of sales. So in cost of sales, the only difference is this term. In our AS level, we used to solve it by using the formula opening unit finished goods, add purchase. We use the word purchase in our AS level because it was a trading business. Add purchase less closing stock of finished goods or closing inventory of finished goods. We got the cost of sales, and when we deduct this, you get your gross profit. So the only difference out here is instead of purchase, we use the production cost. This production cost is transferred from the manufacturing account. So the manufacturing account is this format. Now I might have gone a bit fast, but this is just to show you how the format is. We will be studying more in the following presentation. So let's move forward. So before moving forward, keep one thing in your mind. To get your manufacturing cost, this is your manufacturing cost, you need to add prime cost. You need to add the prime cost plus factory overheads. Remember, factory, you need to add the factory overheads. So what is this prime cost and what is this factory overhead? That's a question which will be answered soon. Okay, here's a question we need to answer before we go into further depth. Explain why a business prepares manufacturing account. Now, why do you think a business prepares manufacturing account? There could be a number of reasons. Some of the reason I'm going to just read it out as quickly as possible. Number one reason, to ascertain the cost of goods manufactured. You want to calculate the cost of your goods manufactured. That's why you are making your manufacturing account, assuming you have a manufacturing business. To ascertain the profit of the factory. So you have a factory, how much profit did you make by manufacturing goods? To fix the selling price, at what price you want to sell it. To evaluate the performance of factory. Is your factory doing good or bad? Make or buy decision. Let's say you want to make a certain product. Is it profitable to buy it from the external suppliers, or is it profitable to make it yourself? So buy and make decision. It helps you to make buy and make decisions. Control cost. Well, in the factory you have a lot of cost, direct and indirect cost being incurred. It helps you to control it. Well, evaluate the factory manager's performance. How good is the factory manager? Is he working well or not? And how to motivate him? Those topics, those decisions can be made based on the information derived from your manufacturing account. That's why we need to make the manufacturing account. So I have given 7 points out here. In your final exams, you could be asked like any 4, any 5. So try to remember this reasons: cost, profit, selling price, evaluate performance, buy and make decision, cost control, evaluate manage performance. The red markings are important to be recalled. Manufacturing business prepares manufacturing account excuse me as a part of the internal financial statements. So it's simply prepared as a part of internal financial statements, not for external purpose. So manufacturing costs, let's understand the manufacturing cost. It's comprised of the prime cost plus the factory overheads, which we studied. So now we are going to understand what is prime cost. So cost can be categorized into material cost, expenses, and the labor. MEL, material, expenses, labor. Cost categorized as there's 3 types. Material can be direct or indirect. Expenses can be direct or indirect. Labor can be direct or indirect. So sum of all the direct cost is called your prime cost. Remember the code DMAIL: direct material, direct expenses, and then direct labor. The sum of indirect cost is called your overheads. So sum of indirect, if you add I in front of these three headings, that becomes indirect material, indirect expenses, indirect labor. If you add it up, it's your overheads. If you put D in front, direct material, direct expense, direct labor, it becomes your prime cost. Overheads can also be categorized as factory overheads, office and administrative overhead, selling and distribute overheads. So factory overheads are all your indirect expenses incurred in the factory. Office and administrative overheads are all the indirect expenses incurred in the office and administrative department. And selling and distribution overheads are all the indirect expenses incurred in the selling and distribution department. More about prime cost. So this is your factory. This is the carpenter's factory or the carpenter's workshop. So let us list some of the prime cost or some of the direct costs involved in the carpenter's factory. So the prime cost, it's the sum of all the expenses that can be directly and clearly traced to the final product. So let's say our final product here. This chair is our final product. So all the expenses that can be directly traced to the production of this chair is our direct expenses, or you can simply say prime cost. So let's have a look at some of the examples. Purchase of raw materials, it's your timber out here. So when you are purchasing raw materials to make the chair, that's your direct cost. Carriage inward, the transportation cost incurred to bring this timber is also your direct cost because it can be directly traced to the production of the chair. Wages of the carpenters. So we have used, let's say we have used 10 carpenters to make these many chairs. So the wages paid to these carpenters are your direct cost, prime cost. Direct cost means prime cost. Wood glues, the glues using the wood to stick it up is also your direct cost. Wages of assembly workers, workers. You can see a worker assembling the chairs, so the wages paid for him is also your direct cost. The pens required to color the chairs is also your direct cost. The screws and nails used in the chairs are also your direct cost. So that's the conclusion of prime cost. Code DMAIL: direct material 10, direct expense 10, direct labor 10, add it up, you get a prime cost as 30. Direct material is also called material consumed. In most cases you might have to calculate it using the formula, so you need to remember this formula. Okay, so you have this direct material component 10 out here. Sometimes you might have to calculate this data. Here it is given, so it's easy. In the question also it was given, easy for you, else you need to use the formula and calculate it. So what's the formula? Let's have a look at it. This is the formula which you need to remember. It is very important that you know this formula, because if you miss this formula you can get your answers wrong. So calculation of material consumed or calculation of direct material, whatever it is, to calculate it you need to use this formula. Opening inventory of raw materials, add purchase of raw materials, add carriage inward, less closing inventory of raw materials gives you material consumed or direct material, which you need to replace out here. The reason why we are adding carriage inward, because here this carriage inward is a direct cost involved, the transportation cost to bring your timber. So keep this in your mind. Pause the video for some time and remember this formula. Next one, we are talking about factory overheads. We are concerned only with the factory overheads, not with other overheads. So factory overheads are the sum of expenses that cannot be directly traced to the final product. So prime cost was those expenses which could be directly traced, but here factory overheads are those expenses which cannot be directly traced to the final product. So our chairs are final product out here. So let's see some of the examples of the factory overheads or the indirect cost. Rent of factory or the workshop. So the rent of this factory or the rent of this workshop is your indirect expenses, because it cannot be directly traced to the cost of the shares. The depreciation of factory machines, you have machines inside this factory, so the depreciation on it is also your indirect expenses. Factory power and fuel, indirect wages like supervisor's wages. So if you have a supervisor who is supervising the whole factory, his wages cannot be directly added to the final product as you choose, so that's also your indirect expenses, or you can say factory overheads. Factory staff food expenses, factory stationery expenses. So basically what you need to understand is, for factory overheads, all the indirect expenses that are incurred in the factory is your factory overheads. Types of inventory. So types of inventory are the stock of your materials, or it could be your finished goods, or it could be your raw materials, or semi-finished goods. So what's inventory? Inventory are of three types. First is your finished goods. Assuming sofas are our final product, the sofas here are ready for sale. These are the sofas which are all ready for sale, so they are on display to be sold off. This is your finished goods. The raw materials used to make the sofas are your wood and then the cloth used to cover the sofa. So the raw materials are unused resources here. So these are our stock of raw materials. Then there's work in progress. That's your partially completed work. So you can see the carpenter, he's making the sofa which is partially completed. You can see a worker assembling the chairs. You can see a sofa out here that is not yet cloth, or it's not, the cloth needs to be stitched to cover it up. So these are the types of inventory which you need to keep in your mind. Finished goods means the goods these are completed and ready for sale. Work in progress are partially completed goods. Raw materials are the materials required to make the final goods. So how to present these types of inventory in our financial statements? Let's have a look at it. So we studied the format in our second slide, I guess. So here we are focusing on the inventory only. So when we talk about the inventory of raw materials, the raw materials inventory are used to calculate a material consumed to arrive at your prime cost. We studied that. This is the formula you can see here. See, opening inventory of raw material, add purchases of raw material, carries inward, less closing raw materials. So the raw materials inventory is applied here to get material consumed that arrives at a prime cost, and then you add a factory overheads, you get a manufacturing cost. In your manufacturing cost, after you get a manufacturing cost, the inventory of work in progress is adjusted out here. You need to add the opening work in progress less closing work in progress. That's applied here. Then you get your total production cost, you add a factory profit, and then you get a transfer price. The transfer price is transferred to your trading account. So in your trading account, you have the revenue less cost of sales. So in cost of sales, the stock of finished goods, or the inventory of the finished goods, is adjusted out here. Opening inventory, you add the transfer price and less closing stock of finished goods, you get cost of sales 108, and when you deduct this from 500, you get 392 as gross profit and trading. That's it. So that's what you need to understand. So basically here we are focusing on how to treat the inventories. Then in the statement of financial position, under the heading of current assets, you write inventory, and then you have to list all the inventories out here. The three types of inventory: inventory of raw materials, inventory of work in progress, inventory of finished goods at the closing stock. Remember, it's the closing value, not the opening value. So this is how you present it in your financial statements. One more time recap. Raw materials is used to find a material consumed to arrive at prime cost. Work in progress is adjusted in your manufacturing cost to arrive at total production cost. Finished goods is adjusted in your cost of sales to arrive at your gross profit. And in the statement of financial position, all three are listed at the closing stock. Moving forward. provision for unrealized profit. Hmm. Provision for unrealized profit. Okay, to understand that, let's have a look at this format one more time. I need to explain to you something out here. So this is our manufacturing account out here. So if you look at the end down here, we have got the manufacturing cost is 70. The manufacturing cost 70 is obtained by adding your prime cost 40 plus factory overheads 30. 40 plus 30 gives you 70. That's your manufacturing cost. Then we adjust the work in progress. We get a total production cost. Now there are two ways of transferring the factory, production to your trading account. One is at a production cost. You can transfer it at 80 down here, or you can add up your profit and transfer it at a profit. So here the total production cost is 80, suppose the factory profit is 8, transfer price becomes 88. We add it up. So if you are transferring here at 88, what you need to do is, and you get a cost of sales after putting the 88 out here, you get gross profit. So in gross profit, you need to rewrite gross profit and manufacturing account, whatever profits you write 8 out here, and add this to 392 plus 8, that's your 400 to get the total gross profit. So if you are transferring it at a profit, after you find gross profit and trading account, you are supposed to use these two more lines again. Let's show your gross profit and manufacturing, so it separately, add it up to get your total gross profit. But this is not done when you transfer it at your production cost. Suppose you transfer it at 80. If you transfer it at 80, this one here, you can also transfer it at 80. The factory has two ways of transferring, as I told you. It can transfer at 80 at the production cost. So if it's transferring at 80 the production cost, it means the profit component is not involved out here. So in that case, what happens is, now where's my marker? Oh, the mouse is on there. So if you transfer 80 out here, you solve this and then you get a value out here. So how much does that come to? So that's your 30 plus 80 minus 10 unit, it comes to 100. So this, where's the mouse, comes here as 100, your cost of sales. So from 500, if you subtract 100, 400 becomes your gross profit. After that, you don't need to do this step. This step is not required. So these two steps are not required if you transfer it at production cost. But if you transfer it at the transfer price as inclusive of profit, make sure you don't forget to do as I said earlier. So provision for unrealized profit account. Let's understand this as well. So we just learned that the factory out here, the factory can transfer the finished goods to the warehouse or the trading department. It can transfer it at a profit. So your warehouse is a place where the goods are stored for sale. When the factory passes its finished goods to warehouse at a profit, a problem arises. So what kind of problem arises? Let's say the unsold inventory is increased by the profit element passed on from the factory. So the gross profit gets increased too, which is against the principle of prudence. So yeah, basically what is happening here is, when the factory transfers its final goods to the trading house or to the warehouse at a profit, what happens is, if the trading house or if the warehouse is not able to sell all of the goods, they will have inventory, closing inventory. So when they have closing inventory, the closing inventory is shown as an income in our trading account. So since it is shown as an income, your income will be in excess. It will be higher by the profit element transferred from your factory. Now, according to our prudence concept, remember your prudence concept, we are not allowed to record unrealized profit in our trading account. So because of this reason, to remove the element of profit tied up in the closing inventory, we need to prepare provision for unrealized profit account. See, the prudent concept states that expected loss is allowed for deduction, but expected profit should not be accounted for until and unless it is realized. So we need to prepare provision for unrealized profit to figure out the unrealized profit tied up in the closing inventories. It is similar to how we prepared provision of bad debt in chapter 8. See the example that follows. So we are going to learn how to prepare provision for unrealized profit account, which is an important part of your manufacturing account. So this is the example out here. So how do you pronounce this? Matisi? What is it? Okay. So Matsi or Matisi, whatever it is, manufactures lawn mowers. He transferred finished goods from the factory to his income statement at a cost plus 30%. So here's the profit element out here. He provides the following information for the financial year ended 30 September 2014. So our year ends in 30 September 2014. This is the end. If this is the end, you need to figure out the start. After September comes what? October. So 1st of October 2013 becomes the start of a year. Now why I'm writing this date is to know your opening balance and closing balance. So this is the start of a year. So we have total production at cost price 7651 that's the production cost of the manufacturing department. Inventory of finished good on 1st of 2013, that's the opening stock. So opening value, this is the opening. And then inventory of finished goods 37 2014, this is your closing. You can say closing inventory. And then sales for the year, that's okay, that's understood. So number A question is saying calculate the transfer price of goods manufactured for inclusion in an income statement for the year ended 37 2014. So we are supposed to find the transfer price, that's it, very simple. So this is how we do it. Total production cost, you have 76500 is given out here. Add your manufacturing gross profit, 30% is given out here. 30%. So 30% of 76500, if you use a calculator, you will get 22950. You add it up, you get a transfer price as 99450. So that's number A completed. Number B, prepare an income statement for the year ended 30 September 2014 showing the transfer. So we're going to prepare income statement. So this is the extract of the income statement for the year ended 30 September 2014. First we find out the revenue. So if you look at the revenue, the sales is 210. That's your so less cost of sales. So cost of sales, we know the formula, opening inventory 6045 is given out here. Transfer price, we just derive here transfer price. Then closing inventory is given out here 6864. So if you subtract this, you get your cost of sales. So when you deduct this, you get your gross profit on trading. So far so good. Now after this, what we do is we need to prepare the profit for unrealized profit. Since there is closing stock out here, it is obvious that there is profit tied up in the closing stock, unrealized profit. So in order to make your provision for unrealized profit, this is the format out here. You have a debit side, you have a credit side, and this is similar to your provision for bad debt. So we have an opening balance in the credit side, that's your step 1. So let's have a look at step 1. That's your opening balance. Opening balance 110 2013 balance BD. This is simply the profit component. This is the profit component. Now how to get this? That's the question. You need to understand this. So to get the you need to go to your opening inventory and then find out the profit component inside this 6045. So in order to get a profit component, what you need to do is you simply write 6045 and we know that profit is 30%, so it's simply multiply with 30 because we need profit. Whatever you need, you should put up. That's the rule of the percentage. We need 30%, so put 30% up, divide by, now you need to write the percentage for 6045. What is the percentage equivalent to 6045? You need to write down here. Now how to know that? You can look in this here how we have solved it. The manufacturing profit 30% of cost, so when you answer the question of what, of cost, that becomes your 100%. So this is 100. 30% of what? Cost. Of what? Cost is your 100%. So we know that this profit needs to be added, so if you add 100 plus 30, this becomes 130. So you need to understand that all transfer price is equivalent to 130%. So that means 6045 is a part of your transfer price, so that's your 130%. So if you solve this, use your calculator, you will get 1395 as your unrealized profit in the opening inventory. In the similar manner, now we go to step 2. We will find the profit tied up in the closing inventory. The closing inventory is 6864, so you will use the same technique. The 6864 into 30, we need the profit portion, divide by equivalent 130%. So you get 1584. That's it. So far so good. Now the next step is, you go to step 3, you simply add the total. The total in your debit side is 1584, the total in your credit side is should also be 1584 because the bigger amount is the total. So now balance it up. Which side is not enough? If you look here, it's 1584, here it is 1395. It is not enough in the credit side. So in the credit side, you put it off as a missing figure. MF is missing figure, and make sure you write income statement. This is done at the end of the year. So you get 189. Now how should we treat this? That's the question. Okay, before doing that, the balance CD becomes BD at the beginning of next year. So it comes here, beginning of next year. This is how we prepare provision for unrealized profit. So now how to treat 189? We see here. So after you get a gross profit on trading account, next what we do is we add gross profit of manufacturing account. The gross profit of manufacturing account is 22950. We put it 22950, and then less provision for unrealized profit 189, which we solve out here. This has to be deducted out here. So the missing figure, this is as good as your expenses, you need to deduct it out here. So when you deduct this two, you get your net figure as 22761 as the net gross profit of your manufacturing account. So when you add this and this, you get a total gross profit as 134130. So I hope you guys understood how to make provision for unrealized profit. This is how we make it, and then this figure has to be adjusted out here. The credit side figure, that's treated as expenses, so you deduct it out here. Now what about in the statement of financial position? I need to rub this. So in the statement of financial position, what we do is, under the list of your current asset heading, here's your heading of current asset. Inventory of finished goods, we have 6864. So you put 6864, and then less unrealized profit, you deduct it. Now this deduction is your balance CD. Make sure you deduct the balance CD. The balance CD, this part here, this up, not this one here. This is the one you need to deduct. The CD part, the CD component, let's say CD. So I'm going to drop this again. Just a bit of confusion out here. Pen, okay. So the balance CD, this part, make sure you understand it. You are supposed to deduct the CD from your current assets to arrive at 5280. So basically what we are doing here is we are removing the profit tied up in the closing inventory. That's what we did. So pause this video for some time and make sure you understand this, because this is part of your manufacturing account. Now I have a second situation. what if this time the debit side is not enough? There's here, see the total out here. Here what happened? You have 1395 in the credit side and then 1390 in the debit side. So the missing figure is going to come in your debit side as $5. Notice it here. Pause the video and see it's going to come here, not here. So what to do in that case? That's the question. So we can easily use our simple logic. If it had come here, we are subtracting. So if it comes here, it means we need to add it up, like in our provision for bad debt. So that's what we are going to do. This thing will remain the same. It will not be affected. So let's have a look. So see, you don't have any balance out here. Here is your balance. Now this 5 will be changed out. See, we are adding up. We add provision for unrealized profit. You add up and you get this. And then when you add up, this data also changes down your total gross profit. So what about in the statement of financial position? Here you need to deduct 1390 itself. Okay. So this side doesn't make a difference. Out here it's always the CD being deducted. But here you need to be careful whether you need to add or subtract. So saying this, I think you have understood the profit for unrealized provision for unrealized profit. Now summary of this chapter. The summary of this chapter: business that produces goods prepare manufacturing account as part of the internal financial statement. So manufacturing account is prepared by those business we produce goods as part of the internal statement. Then a manufacturing account lists all the costs involved in running a factory. So all the costs involved in running a factory are listed there. It is shown as prime cost plus overheads, factory overheads. A manufacturing account is split into sections showing prime cost and second list of factory overheads. So these were the two components used to find your manufacturing account, manufacturing cost in the manufacturing account. Two types of inventory are included in manufacturing account. Yes, in the manufacturing account, inventory of raw material was adjusted, and then work in progress. Partly finished goods means your work in progress. Inventory of work in progress was adjusted. That's right. Goods are transferred from manufacturing account to an income statement inclusive of factory profit. Goods are often means not always, but it can be transferred from manufacturing account to the income statement. That's your trading account, add a profit, we show that. And then a provision account must be opened to eradicate means to remove the unrealized profit from the financial statement. So unrealized profit tied up in the closing inventory. That's what we studied. So after saying this, I should say thank you. And if you want to see videos on how to solve past papers, I will be presenting in the next videos. So saying this, I must say goodbye.